So in general, the Treasury tries to maintain a pretty kind of static ratio between T-bill issuance and longer duration bond issuance. And the problem now is that they're releasing more into the market than normal. There's just the deficits are unusually large, especially outside of a recession or other kind of crisis event.
In this discussion, Lyn Alden highlights a significant challenge in the financial markets related to the U.S. Treasury's approach to managing T-bill and bond issuance. She points out that the Treasury is releasing more into the market than usual, driven by unusually large deficits. The Federal Reserve's quantitative tightening adds to the complexity, as they are not reinvesting proceeds, contributing to a surplus of supply. Alden notes that the strong dollar reduces foreign demand for treasuries, leaving domestic non-bank sectors to absorb the excess. This includes entities with less leverage, such as insurance companies and pensions. The reverse repo facility becomes a crucial factor, acting as a spillover for excess demand for T-bills. The Treasury's aggressive focus on T-bills, despite their higher cost, aims to maintain liquidity and avoid drawing value from bank reserves. Alden suggests that this dynamic has made Treasury refunding announcements more market-moving than Federal Reserve announcements recently, emphasizing the evolving role of the Treasury in shaping liquidity conditions. The interplay between the Treasury and the Fed introduces a variable that can surprise the market quarter by quarter. With that, let's dive into her thesis.
And so there's just kind of like this ongoing quarter by quarter deluge of supply. And the Fed's also doing quantitative tightening. So they are, they're selling through maturity. They're letting bonds mature off their balance sheet and not reinvesting those proceeds, which is effectively a sale. Because the dollar index is strong, there's not a lot of foreign demand at the moment. That's unintuitive to people, but basically, when the dollar is strong, usually the foreign sector is not really buying a lot of treasuries. They're often more in currency defense mode, and if anything, they're either selling reserve assets or they're more often just holding flat. Whereas when the dollar's weaker, they're more likely to be in reserve accumulation mode. And so they're not really on average buying at the current time. And then also banks are kind of carefully managing their duration. And for the first time in a long time, they had an absolute drop in the number of treasuries they were holding. And so with all of these buyers off the table and how much supply is coming, that means basically all of it has to be absorbed by the domestic non-bank sector. So insurance companies, pensions, asset managers, households, hedge funds, and these are entities that generally don't have all this extra leverage. For example, the banking system has leverage, the Fed has leverage. But these are less flexible balance sheets to absorb all of this. And one of the remaining pools of capital, pools of liquidity available, is the reverse repo facility. That you can kind of consider that like a spillover for like excess demand for T-bills specifically, not for longer duration, just kind of T-bills, like cash equivalents with no counterparty risk. I mean, your counterparty is the Fed. And so money markets could easily replace some of their reverse repo exposure with more T-bill exposure. So right now, there's at least $1 trillion worth of T-bill exposure that could rapidly be consumed by the market. Which is not always the case, but that's the case right now. Whereas there's clearly a more limited demand for longer duration, like T-notes, T-bonds. And so rather than just the Treasury kind of keeping with their normal cadence and their normal split of how they're doing things, they've been very aggressive on the T-bill side. Which is interesting for a couple of reasons. One, it's the more expensive part of the curve. So the Treasury has to optimize for a couple things. One of them is trying to minimize expense for the government. And yet we have an inverted yield curve and they're still issuing on excess amounts on the short end. But number two, they're also doing that to not hurt liquidity. They don't want to draw, value out of bank reserves. They'd rather kind of pull from this reverse repo facility. And so basically it was like a bigger than normal jump for what the Treasury would do. I think it's one of those things like it's just not something that most people follow. The quarterly refunding of treasuries it's usually a boring thing. But this was probably the first time where a treasury refunding announcement probably moved markets more than an FOMC announcement from the Fed, just because there was kind of more of interest there. And in some ways, the Treasury has been affecting liquidity conditions as much or more than the Fed lately. And so these two forces have been kind of at odds. And so it's interesting that there's another variable there that can, surprise us one way or another quarter by quarter.
In this segment, Lyn Alden provides insights into the intricacies of modern balance sheet management, particularly in the aftermath of the global financial crisis, GFC. She describes a phenomenon where excess quantitative easing, QE, fills the metaphorical bucket to its limit, necessitating a spill into facilities like the reverse repo. Alden points to the 2019 repo spike as a cautionary example of the challenges that can arise when T-bill oversupply disrupts the market. She anticipates a potential future scenario where the reverse repo facility runs out, leading the Federal Reserve to reconsider balance sheet management and possibly resume QE. Alden suggests that unusual events, such as unexpected spikes in Treasury yields or repo rates, could trigger a response from the Fed to maintain market stability. This, she argues, might be a less dramatic but significant crisis scenario, often overlooked by the average person, but closely monitored by financial analysts and market participants.
So in this modern era of balance sheet management, so kind of post GFC, it's been more of a phenomenon. And basically, when there's been a period of excess QE, that's when it's almost like you've filled as much water as can fit in the bucket for the time being. And so that money just starts having to spill somewhere. And so they open the reverse repo facility, it spills into there. And then when they stop doing QE for a while, it eventually starts draining back out of that and back into the broader market. And so we did see a little bit of usage of it in the prior rounds of QE, QE like 1, 2, and 3. Now, what happens when it runs out? The most destructive period for that is probably the 2019 repo spike. So that was the opposite problem. Right now, there's excess demand for T-bills. Basically, the reverse repo facility represents roughly an extra $1 trillion worth of demand for T-bills that money markets, would happily buy and just take it out of the reverse repo facility. Back in the 2019 period, there was a similar environment of kind of surprisingly big deficits for a non-recession. I mean, nothing like now, but basically deficits were widening at a time when we were not in a recession yet. And the Fed was doing quantitative tightening like they are now. And out of nowhere, repo rates just blew out. So basically, rates that financiers deal with each other overnight just went like 7%, like out of nowhere. And so the Fed basically jumped in with emergency repo activity, not reverse repo, but repo. Because at that point, the reverse repo was drained. And there was this ongoing need to finance the deficits. And you also had a pretty strong dollar environment. So there was not a lot of foreign buying of treasury. So kind of all the same setup happened, and it manifested in the reverse repo market getting messy. And the problem there is if that had persisted, it would have spilled over into the treasury market because at that time, especially, the remaining buyer was hedge funds. And they were using repo to finance their treasury purchases, and so obviously you can't finance at 7% and then buy whatever the T-bill was yielding back then, which was quite low. So they came in, they stopped doing reverse repo. There are some of us analyzing it at the time, like myself, Luke Roman, a handful of analysts, because a lot of people were trying to figure out what was happening. Whereas our argument was that this was basically a T-bill oversupply problem, and that the Fed would, it seems like a repo problem, is actually a problem of just too many T-bills relative to other liquidity. And so that the Fed is probably going to come in and have to start QE again. And within weeks, that's what they did. By, the repo spike happened in September. By October, they started doing QE. And they didn't want to call it QE because they were only buying T-bills. They weren't buying longer duration. And they were not doing it for the intent purpose of stimulating the economy. It was just kind of managing liquidity. They were just going back up to a gradually expanding balance sheet again. So I think we could run into a situation like that where you kind of hit zero and maybe you stay at zero for a while as the Fed keeps draining. But then some weird dislocation happens. Maybe treasuries shoot up 100 basis points one day. Maybe repo rates get weird one day. And then it just kind of, most, unlike a bigger crisis, this was one that only really market participants or like financial plumbing analysts were looking at. The average person on the street was like, what are you talking about repo? Like it doesn't matter. So this was one of those like non-crises. And I think basically what happens when the reverse repo ends is you probably get a similar event where one day the Fed just has to be like, oh, well, we're not going to reduce the balance sheet anymore, and we're going to go back up to a period of slow balance sheet management.
Let's recap today's discussion. Lyn Alden provided valuable insights into the complexities of the current financial landscape, focusing on the Treasury's approach to T-bill and bond issuance, the impact of excess QE, and the crucial role of the reverse repo facility. We learned about the challenges posed by large deficits, the Fed's quantitative tightening, and the potential risks associated with T-bill oversupply. To recap, Lyn highlighted the delicate balance between Treasury actions and market liquidity, emphasizing the unexpected influence of Treasury refunding announcements on market dynamics. She also touched upon the potential consequences when the reverse repo facility runs out, drawing parallels to the 2019 repo spike and the Fed's response. If you found this discussion insightful, make sure to subscribe to our channel, hit the like button, and share your thoughts in the comments below.